So my biggest tip is find a company out there that follows the audit technique guidelines and does, the guidelines gives you 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 steps of what you need to do to perform a quality study.
What's the number one secret to cost segregation, right? As well as making sure that you stay, compliant. Leveraging this tool, and maybe a couple others we'll touch on here, so that you can create and preserve more wealth.
Well, like every strategy out there, there's the right way and the wrong way to do it. And what the IRS, I'm not going to go into the depths, but what the IRS did is they sued the Hospital Corporation of America, and the Hospital Corporation of America won. Part of that case, which was in 1997, is the judge who did not like the IRS's case at all, said, look, you've got to tell everybody that they should be doing cost segregation and how you want them to do it. So in 2004, the IRS published the audit technique guidelines for cost segregation. It's online. Everybody can read it. If you're not getting to sleep at night, read this 200-page document. And so bottom line, that gives us all the rules. If you want a quality study, the IRS tells you how to do it. And so our mantra from my very beginning has been following the audit technique guidelines and doing it correctly. So my biggest tip is find a company out there that follows the audit technique guidelines and does, the guidelines gives you 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 steps of what you need to do to perform a quality study. And that's our mantra. That's what we do.
Perfect. And by the way, you can learn more about Joe. It's such a
Viery.
it's fiery, right? Fiery with a V, maybe fire with a V, Viery at USTAGI.com. That's USTAGI.com. Okay, great. So first thing is understanding that what's available for you, what's out there, and then working with a group that is going to make sure to follow the letter of the code, right? And do the necessary steps. Of course, you probably want someone that's experienced and has done lots of these, and they perhaps had to defend this versus their clients versus the IRS when they did an audit or something along those lines. But at the end of the day, cost segregation is what, Joe?
Cost segregation is relatively simple. It's very complex, but it's simple. All we're doing is we're accelerating the depreciation expense the IRS allows building owners. And what depreciation is simply the IRS recognizes that you're using up your building. It is decaying in front of your eyes through every year that you own it. So for residential buildings, straight line depreciation, the IRS says divide by 27 and a half years. How they came up with that, I don't know, and I never looked it up. For commercial buildings, it's 39 years. And so all we're doing is telling the client, do you want to wait 27 and a half years to get all of these deductions? Because don't forget, if you want to defer or eliminate your not defer, but if you want to eliminate your income taxes, the higher the expense items you have, the lower your taxable income. It's very simple bookkeeping. Anybody understands that. So what do? We give you that depreciation all up front in the tax year that you buy the property. So we're not doing any hocus pocus. That's all we're doing. And that gives you the ability to take a big chunk of that depreciation and use it against taxable income.
Yeah, it's one of my favorite strategies, right? And exactly right with multifamily, 27 and a half years, commercial 39 years. And then also if you can buy, first of all, it's cash flowing producing real estate. It has some value add opportunity and that you're buying it on the intrinsic value, but also you can leverage very low interest rate debt, and that can help you get the full amount. Remember, your depreciation schedule is based upon not the land, right? Because the land's maybe 20% of that, but let's say you bought a $10 million building and $2 million of that is subject to the land. So you have $8 million of depreciable assets. Multifamily, we've seen about 25% of that $8 million in that year 1 or 2 is generally what you can do, right? And so we're talking, in that scenario, just to break it down for folks, if you take 8 million by 25%, that's $2 million, right? And let's say you had a gain somewhere else for $2 million, or you're in a 1031 exchange and it's failing and you're like, oh my gosh, what am I going to do? Well, you have that $8 million deal, you have that $10 million deal over there, which $8 million is, you can do 27 and a half years on. Why don't we accelerate that and wipe it out? Is there anything I'm missing there, Joe?
No, do you need a job? So that's excellent. That's exactly what we do. And it's so powerful. I'll go a little step further though, because that is basically, as you explained it, on a value add, that's phase one. Phase two is, what do you do to the value add? Is you rip everything out. And I know what you do in multifamily because we do lots of multifamily. You know what you do. You rip out the countertops, you rip out the flooring, you rip out the window coverings, blah, 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 blah. You throw it in the trash and you put new items on there. So the other part of our study, which you get with cost segregation, is you get the value of the stuff you throw in the trash. That is a tax write-off. You want write-offs. Then the third thing we do is, if, let's say you spend $1 million on the renovations, then we do the acceleration on the $1 million.
Okay, so make sure I got that one, because that is, I like that little nuance there, and we like to geek out on these type of subjects on the Capital Gains Tax Solutions podcast, right? That's the whole reason we're here. So yeah, step one is just the you bought the value for 10. 2 million is not applicable because it's land, so they have 8. Now you can depreciate, boom, that, and then let's say that's year 1, let's just say, and you're saying, like, let's say year 2 you're starting the renovations, right? And at that point you're saying, as I'm tearing stuff out, I get an additional bonus on that, or walk me
it's
through.
not a bonus. Here's how it works. In
Yeah.
2014, the another great tax bill came to play, which was called the Tangible Property Regulations. And so what the IRS said is, look, man, we're done with all of you guys scamming us. So now we're going to make bright lines so that you guys can't expense your dog and all of these things. So they gave us rules, a rule book. Part of the rules is they do not want 2 items on your depreciation schedule. So what's item number 1? Item number 1 is you bought the building for $8 million. Here's the building. In that $8 million, and this is why you need an engineer, is the allocated cost for all the building components. So guess what? The roof is in that $8 million. So if you put a new roof on, you basically now have 2 roofs. You have the old roof in that $8 million. You have the new roof that you spend $100,000 on. And the IRS is going, no, you got to get rid of one of those. So obviously you're going to get rid of the old roof. Well, how do you know how much that roof is worth? Well, it's not worth what you paid the roofer for, because that was for the new roof. It's what was baked in that $8 million. And guess who defines that? We do. So now you know what your write-off value is on that roof.
Got it. Right. And so that's stage 2, which is awesome. And then stage 3 would be all the new stuff that you're bringing in there, right? Which I guess essentially you're doing another study, or would you do are you doing a second study at that point?
Another study. Yep.
Yeah, another study. Okay, cool. So you do another study, and you're like, hey, we just put on new roofs, new countertops, new flooring, new windows, right? Blah, 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 all across the thing. And then boom, you do it again. And so, yeah, it's like the gift that keeps on giving. It's like, Christmas come multiple times, Joe.